room. I'm here to learn with all of you. Thanks, Marty. Thanks, squad.
Great, thank you, Alkina. I think I'll let Monty introduce himself, and then maybe let Tom Gryp introduce himself, and then we'll hand it over to Monty to do the presentation. So I just want to do it quick.
Sure. Hi, I'm Monte Anderson, and I'm one of the senior faculty and the founding members of the Incremental Development Alliance. I'm from Dallas, Texas. I have been doing Incremental for a long time, over 30 years. In fact, my company celebrated its 30th anniversary this year on October 9th. And I've been coming to South Bend, I think we're coming nearly 3 years now, I've been coming up here. So I feel like this is the second, a lot of them I know. And I really like this place up here. I should have been born in the north. Somehow I was born in the wrong part of the country. I love the snow. And we just had 0-degree temperature in Dallas a few days ago. And today it's 70 degrees. So the 70-degree swing. But we have Tom Gryp with us here tonight. And Tom, why don't you introduce yourself real quick?
Sure. Hello, everybody. I recognize some familiar faces. I am the CEO and president of the Notre Dame Federal Credit Union, and I've been doing that job for about 11 years. But I like to say that's what I do, that's not who I am. My heart is South Bend. I grew up here on the west side over by Music Park and over that way, and this kind of development is something we absolutely need to do. And personally and professionally, I'm here to help any way I can. So thank you for inviting me.
Thanks, Tom. And just a little bit, one of our small developers here in South Bend and I are going to partner up like we're team members, and we're going to interview Tom. We'll talk about that and how to get money, because that's what this is about tonight. Most of the people like me, I grew up in the southern part of Dallas County, which is the have-nots side of Dallas, because Dallas is a very rich city, but in the southern part of Dallas County, we have one of the highest child poverty rates in the country, and lots of other issues that we have in that area. And so I'm used to places that are not so fast, that are not moving so fast, and having to do with little bits of nothing to start building wealth or building a real estate development. So tonight we're going to talk a little bit about financing and banking tips for small developers. Next slide. So what is this about? What are the basics that I need to get financing? Where's the money coming from? And how to be a small development, how to be in business to doing small development. Because this is really not a part-time business, although most people start part-time. And I'm not saying that you can't start part-time, but this is a hard business. And we're going to look at how to do that, how to get more into business on a day-to-day basis. Next slide. So, and I'm always going to go back to one thing that Willow and I were talking about earlier, and it's farming. See this farmer here? This farmer here, he knows his farm field. He knows his territory. He knows how to till the soil and plant the seeds and pull the weeds and how to water it. And he knows about this. Now, he didn't get off his tractor and go down the road and get on somebody else's farm and start farming, especially in harvest season. He stays there every day. And that's what you do as an incremental developer, is cultivating your neighborhoods. It's like, you know the streets, you know the bankers, you know who's moving around, you know who may be selling their building, you know who the best pie maker is in town, who may become a pie entrepreneur. See, you know all these things because you grew up in the neighborhood, you traveled the streets, you know where the parks are, you know where all the bones are buried, you know everything about your neighborhood as a small developer, incremental developer. And so we're going to talk about that always. We'll always start with that. And so cultivating your neighborhood farm is the basics to this process. Next slide. So, you can start with a little modest house. Okay. If you've got nothing, you can go get an FHA loan and rebuild a house and move in it and rent one of the rooms if you want. Or you can live in it yourself till you can do another one. So it doesn't take having to start with building a big tall building or a big shopping center. Next slide. So these are a couple of buildings after you built the house. See, this was an old building here that was a real estate office that became a pet store. And this is a mechanic shop that became an outreach center. Next slide. And this is a post office that became a call center. So see, you could take a building like this, that's an old post office, and put an answering service in it or a call center, and now they answer phones for air conditioning companies and all kinds of people. Here's an old church that lost its parking lot and stuff, and it became a retail center. Next slide. Here's another post office. See, you take the second floor off and put 2 apartments upstairs. See, so you can incrementally, you can move up. You can start with that one house, and you can constantly always be moving up. Next slide. Here, you get a little bit bigger, then you can build you a mixed-use building. And this is only 11,000 square feet up and down. It's a $3 million building. So what I've showed you here today is everything from 125,000 to 3 million. And you can stay in that range your whole life, and you can make a lot of money and build net worth and build wealth for your family. And maybe you're not going to get into building big apartment buildings and big strip centers and things like that. But I know a lot of people that make a lot of money just doing small things like what I've showed you here today. Next slide. This is just another photo of that little mixed-use building. As you can see, these little places like this, see, this is like an 800 square foot bar. So you don't have to build a 5,000 square foot bar. In fact, I would say post-COVID, we're going to see everything small and lots of takeout, obviously. Next slide. Okay, so how to identify a deal. This is what I used to call it the walk-in pro forma. It's the pocket pro forma we're calling it tonight. Next slide. So this is how a building makes money. See this right here? These words right here. Tom can take this sheet right here, and he can nearly make you a loan with this one sheet. See, because a building that makes money is not like appraising your house. Let's say you have a house that you bought and it got appraised by the comps in the neighborhood. It got appraised because they're selling for $100 a square foot or $125 a square foot. This building here it gets its value from what's called the net operating income. See the net operating income there. So this really simple thing. See, we're going to go through the steps. Next slide. So this is a building that makes $2,400 a month. It's a duplex, $1,200 a piece for the units. That's the yearly budget, income. And the operating expenses, the taxes, the insurance, the maintenance of the facility are $10,000, and a vacancy, you have a little bit of a vacancy factor. Okay? And we call it the Bernice Rattle, one of the other faculty calls the do-good budget. This is where she puts in like giving money for flowers or painting benches in the neighborhood. She does that on all of her projects. So you have a net operating income of $17,280. And from that one number right there, from that number, see this building, there's the income and the expenses and the net income before the bank gets involved, before the debt service. That one number right there is the most important number of an income producing building and how they make money. Next slide. So if this building here making $17,280, it cost $200,000 and it needed $60,000 in improvements, and it had soft costs of $50,000. The total cost of this building was $275,000. Okay, are you with me? Next slide. Next. Okay, and so to buy this building, generally speaking, you need about 20% down. Generally speaking, that's going to all depend on your personal credit and some other things, and what your net worth is, what assets you are, and what kind of relationship you might have with a bank. So in this case, you need $55,000. You get a loan for $220,000. The monthly payments, the principal and interest, are $1,050. So the annual debt service is $12,640. So now you take that net operating income minus the debt service, go to the next slide, and you get $4,676 in cash flow. Now here's two things that the bank is looking for. This debt service coverage ratio down at the bottom, that's a really important thing that banks look for. And what that is you're saying I'm taking in, I have $1 in payments in payments on the building, and I'm taking in 1.37 times more. See, in this case here, I'm taking in $17,280 a year, and I'm spending $12,000 in debt, in principal and interest payments. So that's 37% more I'm taking in. And so what a bank wants is, they want you to be taking in more than it's costing to pay them. And then it has a 9% cash on cash return. That's on your down payment, the 9% is. And so this little page right here, if you can learn this, and what this means, you can do just about anything. Just on this page, that's how simple it is. Next slide. Okay, so many of the people that come through our courses fail to do one thing that's very important. And if you're going to be in the real estate development business, you've got to have a real estate attorney. You've got to have somebody up front. You've got to form, either if you're going to buy your real estate with an entity like an LLC, which is what most people do, but you need an attorney to do everything legal. You're signing contracts, okay, legal contracts. I don't know about you, but I don't take that lightly. If I sign a contract and I default on that contract, somebody can sue me. Okay, they can sue me. So I would want to have my attorney look at my contracts, all of them. Also, the attorney is going to form the entity that's buying the property. Like Marcella and I are going to pretend we're partners in a little bit here. We're going to form the Marcella and Monte LLC. And that LLC is going to buy real estate to make us wealth. When you get a loan from the bank's going to draw up legal papers called loan documents and some other things, a bunch of other big stack of papers like this. There's no way you can read all that and know what it means. The attorney's going to look at that. And then you're going to lease the property. You're going to lease the property with a lease agreement, a legal agreement. It's a legal document. You need somebody to advise you to say this is good. And then any other legal agreements, and they all have serious consequences. Next slide. Okay, so also you may need, let's say that in this case here, there was $55,000 needed. So where are you going to get that $55,000? From investors. The best place when you're starting out to get money for this kind of investment is family and friends, people that trust you. So let's say that you need $50,000. Now $50,000 may be a lot to get from Uncle John or Aunt Harriet or something like that, but they may be able to give you $15,000. So see, you might be able to get 3 investors to give you $15,000 each. Be easier, right? Be easier to raise $15,000. You know somebody can give you $15,000 maybe if you had a good deal? 5,000? Maybe, okay. So what you're going to learn from us is how to find somebody that can give you $15,000. Because there are people in your neighborhood right now, and people that you know in South Bend, that have that kind of money that can invest with you if you present yourself properly. If you present yourself right. And then as you get a little more sophisticated, there's what's called accredited or sophisticated investors. This is a case where if you're out there raising money from people, you got to be careful who you raise money from. You can't go around and raise money from little old ladies that have their last $20,000. You have to, if you're going to get people to invest with you, you have to have what's called an accredited or a sophisticated investor. And what that is a person that's worth maybe at least $1 million and has an income maybe of $200,000 a year. That's a sophisticated investor. You see the difference? If I'm making $200,000 a year, I would be considered a sophisticated investor versus the little old lady down the street who's got her last $20,000 you're trying to get the money from. So that's against the law. Next slide. Who might lend on your project? Next slide. So this is the basic capital structure of borrowing money. Let's say that we're going to buy an old house and we're going to fix it up. So this is what we're going to need. We're going to need a down payment, like we talked about, and then we're going to need a construction loan. That's a loan that's a loan that you get while you're doing the construction, while you're fixing up the property. If you were building a new building, you would get this construction loan. So you'd have your equity down payment, you would take it to the bank, you put it in the bank, and then the bank would fund the construction as you did it, as you did the work. And then when you get through with it, with the property, you're going to do one of two things with it. You're either going to turn around and sell it, okay, and make a profit on it, or you're going to keep it and try to get more permanent financing, okay, with the bank so you can rent it and make cash flow. So this is like a really basic capital structure of how you would get a piece of real estate. Next slide. So these are the easiest at the top, more complex at the bottom. The easiest thing to get is personal debt. Okay, that's money from a family member or somebody that you know. A little more complex is residential mortgage. That's the mortgage you get on a house. You know, you got to buy a house, you got to put 5% down, 10% down. And then the more complex is commercial mortgages. That's where you have an income of more a 1 to 4 unit or more commercial property, and you get a commercial mortgage on. Next slide. So personal debt, this is like you would go get home equity loan on your house. You would borrow money from friends and family, or you might do something that's called hard money, which I highly recommend that you never do. Hard money from one of these guys that will give you money for like 14, 15, 18% interest. Some of you may have done that before, and that's not a good formula for success. Please don't do that. And then this is best for fixing and flipping accessory dwelling units, like that's the unit you might build in your backyard to make income from, or single family homes, duplexes, small little buildings, or light renovations. Next slide. So that's what I just described, these kind of things. Next slide. So residential mortgage, these are types of debt. These are local bank construction loans, local bank permanent loans, FHA loans, VA loans, you know, conforming Fannie Mae loans, those kind of things. That's how you, like what you normally see buying a house. And so you can get an FHA loan, you can get up to 4 units through the FHA, 1 to 4 units. So if you bought a 4-plex and you lived in a section of it, then you could get an FHA loan and rent out spaces to 3 other people. Live, work, commercial with an owner suite, Main Street rehabs, like little mixed-use buildings on Main Street, mortgage, and next slide. These are what I just described. Next slide. So commercial mortgages, this is where you might get a loan for your business to occupy a building. The SBA, you can get an SBA loan through a bank. It's a small business administration loan where if you occupy over 50% of the property, then you're eligible to get an SBA loan. So you can occupy a portion of the property and lease out a unit or 2. The commercial banks do construction loans, and they do what we call mini-perms. This is a mini-perm loan is like, and this is typically what I get on all my commercial loans. It might be a 5-year loan, but it's amortized over 20 years, so the payments are lower. So at the end of 5 years, guess what happens? Anybody have an idea what happens 5 years? It blows up. It's like due. I either have to get the bank to renew it, or I have to pay it off, or I have to go somewhere else and get a loan. Most banks renew those loans, unless you hadn't been a good borrower, then they may not want to. And they're small balance loans. And they're best for 5 units or more, mixed use, commercial, multi-tenant, or land development. That's what the commercial loans are usually used for. Next slide. There you go. There's some of what I just described. Next slide. Okay. Another problem that we see quite often is contracts. So if you're going to get a loan on a piece of land that you're going to build on, and you go sign a contract, you're going to sign it at a contract date. And you got to have a lot of time in here for inspections, plans, engineering, and for financing. So I would say if you went out and put a piece of land under contract that you had to close in 30 days, you're not going to be able to get all of this stuff done. You're going to need a long period of time. So these are key dates. When you sign a contract, like if you sign a contract on January 1st, and you have an inspection period, that's the period that you can do your due diligence. You'll You'll look at the property and see if the roof's good, or if I can actually build a house on this property, or if the plumbing's good, the inspection period. And then you also want to get your survey and title. So you have a date that the survey and title has to come in. And when you get to survey and title where you get all those documents, what do you do with those documents? Who do you take them to? The attorney. So the attorney can look at it and see, am I buying this property? See, I've seen people buy properties before that was the wrong property they were looking at because they didn't have somebody look at those documents. And then financing, the financing date. So you want a contract, you want to put something under contract, you want to have a period that you can get your financing or you get your earnest money back, you get your money back, the financing period, and then the closing date. So these contract dates are very important, and we could spend 2 or 3 hours on this. These dates are very important though. Next slide. So you're also going to need, if you're going to get into this business, you're also going to need somebody that keeps your books. You're going to need a CPA. You're going to need a bookkeeper. It's very important that you have somebody up front. Don't get into this business and get real out of whack with your paperwork, because when you go to the banks and you don't have your paperwork in order, you're not going to get a loan. I don't care how good you are, you're not going to get a loan at a bank with your paperwork not in order. Next slide. The package. This is the part that if you create, next slide, a package, this might make the difference whether you get a loan or not. I'm going to show you a package on Portage Place. This is Mike Keene's deal that we're working on currently. It's the old Ford Bakery building. And you can see on the first page of this package, and we're going to give you this too, by the way, so you can use these to copy. We've got a little introduction of the building. On the second page, it tells a little bit about it tells the table of contents. Next page. And then it tells you a little overview of what's going on in the neighborhood in the building. And then the most important page, again, this is one of those pages that you can get a loan on if you just have this page right here. This is the cost, okay? This is the income summary, okay? The terms of the loans, and then the cash flow. So this right here, Tom's an analyst, any of the bankers analysts out here can take this page right here and pretty much tell if they're even in the ballgame. If you're in the ballgame, you get a loan. Next page. So this is more filler, I call it. It's market data, stuff that could be important if your banker doesn't know what neighborhood you're going into. Next page. More about locations and benefits to the community. These are all important, but they're not the most important for the bank. Next page. The same here, just more the team summary. Who are you? What's your experience? The bank wants to know that you've got experience. You're going to be able to operate this. You're going to be able to build it. You're going to be able to finish it. See, they don't want to loan you money and have to finish it themselves. Next page. Okay, this is about zoning, but this is the plan. This is the building plan. Here's the elevations of the building. Here's the floor plans. One of the most important things is an as-built floor plan of what you're going to do inside that building, how you're going to lease it. How can you prove that I can lease this? I've got a building that's been vacant for how many years? 70 years, 50, 60 years. How can I prove that I can lease this? We can prove it by the way we laid out the floor plan. See, in this building, we've got spaces that start as little as $500 and up a month. So when you talk to the bank or the appraiser, they're going to say, well, how can you lease this? Well, so you actually say, well, Mr. Banker, do you think I can lease a space for $500 a month? Do you know somebody we can lease space for $500 a month? Okay, do you? Okay. So we're not trying to get a $5,000 a month occupant in the building. We're trying to get small tenants in the building. Next page. Okay, this is a construction budget. You know, concrete, drywall, paint. See, here's the bottom line. Construction budget. You're going to need that. Next page. Okay, this is a rent roll. Now, what is a rent roll? A rent roll, each of those numbers is a space in the building. And when you get a tenant in the building, by each number, you're going to have the tenant's name. So like one there could be John's barber shop. Number two could be Harry's bakery, Sally's Florist. Okay, and each of these numbers, it's got an amount in rent that comes in. So the bottom line is, next slide. The bottom line is we know how much money we're projecting to come in. We're projecting that. We've got realistic projections. And then we've got just further layout of the plans so we can make those numbers happen. Next slide. This is just market data, more filler package market. Next slide. Next slide. And then it's just to wrap up of the property, what we're going to do and who we are and what kind of experience that we've got. Next slide. And this next slide that's the package, and we're gonna give you that package if you want it. Any of you that want that out there tonight, you can have this package and you can use it to formulate your property. The next slide is what we're calling the flywheel. And this is how to get into the business of being a small developer. Okay? Bernice Radel and I and Grayson Johnson, Bernice is from Buffalo and Grayson is from Canada. Not too long ago, we worked on what the org chart looked like of a small developer. And you know how most corporations have the pyramid, the bosses up here and the vice presidents and so on and so on. Well, as an incremental developer, you're really in the middle of everything. You're involved in like everything. So in this case here, I was a real estate agent. So I do my own leasing, and I do my own property management, and I do my own construction and development. So I make money, I pay myself fees for doing those things. So that's how I make my living. That's how I make my daily living, okay? Then I make my wealth off of the value of these buildings. So this is where I am in that red box right there. Now, if you're an architect, see, I'm not an architect. If you're an architect, you might get into the flywheel as the architect. And you might start off by saying, I don't have a development to do, but I'm going to start doing all the architectural work in my neighborhoods. Or I'm going to start doing all the construction in my neighborhoods. That's getting into the flywheel, into the farm. So you're doing work in the farm. If you're an attorney, you could do this as an attorney. You could get in. So you're working in the farm doing one of these jobs. See, marketing, leasing, cleaning, make ready. I mean, you could be doing any of these things. So you're getting into the flywheel. That's what you want to do. If you're working for a hospital in the next city over, are you in the flywheel? No. Okay. Or if you're working as a school teacher or somewhere else, are you in the flywheel? Probably. Okay, so what you want to do is get into the flywheel, and this is where you start making money. And you can start off as a leasing agent, an architect, a contractor, a make-ready person, a cleaning person, and you can get involved, and eventually you'll find your deal. So even if you don't have a deal today, even if you don't have a building today to do, you can still get in here by doing one of these jobs. Next slide. So probably here's where you are, and this is one of the ways I explain incrementalism. You may be here today thinking about doing this kind of work. And this is not flipping homes like you might see at the Holiday Inn seminar. You know, you see those all the time, right? This is about committing to your community for your whole life and then making money off of building it up and rebuilding your community. And so you may be on the bottom of the ocean today, down here, and you're going to the moon. And there's 12 steps here. And the first thing you got to do is get you a mask and some fins and stuff so you can start swimming. If you start worrying about, while you're on the bottom of the ocean, if you start worrying about building the rocket ship, what's going to happen? You just got to quit because you haven't taken the proper steps. And so what we want you to do, what we do, we teach how to take those steps properly. By the time you get to the beach, you're going to be a much smarter person. You're going to be a different person than you were when you were on the bottom of the ocean. And so you're going to know what to do better if you take these incremental steps. So small steps equals small mistakes. So if you go out and buy a house today and you start fixing it up and you spend more money on it than it's worth, you probably won't go bankrupt. Okay, you could probably, if you have to, you could move in the house if you had to and live in it yourself. So this way, you can make take small steps and learn the business, because this business is a complex business and you need to make lots of transactions. You need to do lots of deals to make it work. You need to just start getting going and doing projects. So with that, what we're going to do now, Tom's going to come up and talk to you for a few minutes just about what he knows. And then Marcella and I are going to sit over here and we're going to interview Tom. Here's what we're going to do with Tom. See, we're not asking Tom for a loan today. Marcella and I are not. We're just interviewing Tom to see if he's the right bank for us to deal with. We want to find out all the information we can from Tom. See, there's no pressure on us today. If you go to Tom today and I need money, like if I'm going to Tom and I need some money today, I'm a desperate person. I'm desperate. Okay, that doesn't feel good. Nobody wants to be desperate. Nobody wants to beg for money, right? Is there anybody in here that just likes to go and beg for money? So what you want to do is find the right banker by interviewing and then begin to build a relationship with that banker. So Tom, why don't you come up and say a few words, and then Marcella, you and I are gonna move over here. We're going to do a little interview.
As I thought about how to frame this up for you, the best way to think about it is anytime you have an interaction with another person, it's important to understand where they're coming from, right? Because how can you negotiate with somebody or become a friend with somebody or create a win-win scenario with somebody unless you understand what makes them tick, okay? And the biggest mistake that I have seen in the 30-some years I've been doing this is that people come in and ask for a loan and they have no idea what they're asking for, what kind of things I think about, and they kind of just wait and see if I say yes or no, because they have no idea, okay? So let me give you some real basic ways to think about this, okay? I'm a banker, all right, or let's just say I'm the credit union. I'm the credit union. What's the most important thing to me? The most important thing to me is to make a loan and then have you pay it back. I know that sounds silly. It's simple, but that's all I care about. Should I make you a loan? All right, because if I make you the loan, I have to be very sure you're going to be able to pay me back. Not only if things go great, but if things go terrible. Okay, all right. So right now, we lend out money. So the money we lend out are money that we get from you as a depositor. So if anybody who has a checking account, you're essentially letting me borrow your money and keep it, and then when you write a check, when you go to the Martins or Myers, you use your debit card and you pay. But while that sits there, and we aggregate it over thousands of people, there's money that I can lend out, okay? So let's say for simplicity's sake, that I have to pay you 0.5% to keep your money with me. Nowadays, it's even less than that, right? I'm going to be able to lend that out today's market for about 4%, maybe a little less, maybe a little bit more, okay? So if I'm going to lend you money at 4% and it's costing me 0.5%, I'm making 3.5% on your loan, okay? And out of that 3.5%, I have to pay my people, I have to pay salaries and wages, and I have to reserve some of that money because not all the loans I make are going to be good. So what I'm saying is my net profit, the best I can hope for is that you'll pay me back and I'll make 2%, right? So from a standpoint of this, when you do your home and your development projects, you want to make more than 2%. How can you make a living at only a 2%? How much risk would you take if you know on a best case scenario, you'd make 2%? Not very much, right? So for me, when I sit down and talk to you guys, I'm saying, how risky is this? How sure am I that you're going to be able to pay me back? Okay? And I'm going to ask you questions. Everything that Monty talked about is absolutely correct. You got to have to lay out. But I'm going to ask questions like, have you done this before? Who are you going to have do the work with you? How much reserve do you have if this doesn't work out? What happens if you don't get a rent or a tenant for a couple months? All these little things could be things for me that could jeopardize me getting my money back and making my 2%, whoop-de-doo, right? So when you come to talk to a bank or a credit union, always remember that you have to make this appear to me like it's as close to a slam dunk as you can get. Now, we all know it's not slam dunk, but you have to prove to me that you've dotted your I's and crossed your T's and you've thought of the worst case scenarios. So that when I ask, you're going to say, well, here's how I'm going to deal with that, or here's how I'm going to deal with that, okay? I'll ask you, have you done it before? First time's always the worst, right? Once you've done it a couple times, you have a track record that makes it less risky, right? The first time, it's kind of a catch-22. So how can you prove to me that you actually know what you're doing? Who are you going to partner with? You have a friend or somebody who's done this before? Because everybody's got to start someplace, right? Don't think you're going to jump in and do it yourself. You can't, right? So as you go through this stuff, I would just tell you, keep it real simple. Trust me, if banking was complicated, I could not do it, okay? It's not that hard. I get money from you from 0.5%, and I can lend it to you for 3% or 4%, and I pray to God you pay me back. And if you don't pay me back, then the worst scenario happens. Everybody loses. Because when I have to foreclose on the property, your credit goes right down the drain. It'll be almost impossible, not possible. It'll be very hard for you to do it again. And I'm going to lose so much money trying to get that house or that building resold that you go, oh my God, I'm never going to do that again, right? So we're always trying to make very, very risk-free deals. So when you come to me, make sure you got all that other stuff out of the way and say, look, I've got my equity, I've got my money in the bank, I've got the plan. All I need from you is some money to build the building out, and I've got it all laid out for you. That's very simplistic, very simplistic. But if you think about it just at that level, it doesn't become, talking to the great odds behind the curtain. It's not that complicated. Understand where I'm coming from and talk to me about the things I care about, and you're halfway there.
Thank you. Stay up here with us. We're going to move this. Yeah. So, Tom, let's see what Tom has to go through. We're going to talk about this, Marcella. So Tom's going to sit over here. Tom's the banker. Okay. And Marcella and I are partners. We're partners right here, Marcella. Marcella's a Spartan graduate here, and she's also in the middle of her first development as we speak. So she's right in the middle of this. But she and I are partnering today because we've been working together for how long now? A year? 7 months? 7 months. Okay, 7 months. So what we're doing today is that we're going to the bank. We don't have a package. See, Marcella's only got her purse, and I don't have anything on me. We have no books, no nothing. We called Tom and said, Tom, we're looking for a bank to do some business with. And Tom says, come on by for a cup of coffee. So we're coming in to talk to Tom. See, we're not asking him for anything. So you understand, if we were here to ask him for something today, it would be like Oz behind the curtain, right? And especially if you've got a contract on a piece of property right now, and you don't have a relationship with a banker or money, you are not going to close on that property. It's not going to happen. So what we're doing is we're trying to build a relationship. This is like getting pre-qualified for a home before you go buy it. So Tom, thank you for meeting with my partner Marcella and I today, and talk to you a little bit about what your bank does.
Credit union.
Your credit union. So Tom is a credit union, but if he was a bank, it would be the same conversation. So Tom, tell me this: do you guys loan money on little mixed use retail and residential buildings? Do y'all loan money on buildings?
Absolutely. The credit union is here to help middle and small size businesses and the average person, and we'd love to help redevelopment, local, small ticket stuff, the things that the larger banks don't want to do. That's our sweet spot.
And what kind of loan limits do you have at your bank? Do if we were to do multiple projects, how many dollars could you go up to with a
We don't-
single borrower?
I understand. We don't like to lend over about $3.5 million to any borrower, but we have the ability to go up to 7 or 8 million. And if we go over that, I can always partner with another credit union to go much higher. So really, in all practical purposes, we don't have a limit.
Is there anything, what do you look for us in particular regarding our credit score, our debt to income ratio?
Right. I look at both quantitative and qualitative. So in terms of quantitative, I want to see how much income do you make? How much money do you make in your taxes? I can see how much that is. How much money do you have in the bank? I want to know what your credit score is. Credit score is very important because it tells me how you handled your credit up to this point. Okay? If you have a very good credit score, we don't have any problems. But if you've had problems in the past, before you and I can talk, we have to figure out how you can repair the problems you've had with somebody else just to get us comfortable. Because we don't want to, that increases the risk, that type of thing. So those are the quantitative things. The other thing is a pro forma similar to what we saw here. Now on the qualitative side, I want to learn more about why you want to do it, what kind of experience you have doing it. Have you ever done it before? Are you going to do it by yourself? It's the how. And I like to learn how that is. And then together we put it together and see if there's something there.
So our LLC is brand new, and this is the first project we're doing. We just formed an LLC, and we're getting ready to do this. Is the LLC going to be good enough to get a loan by itself without us having personal guarantees or credit, our good credit
Right.
ourselves?
Unfortunately, and this is almost a uniform statement, regardless of whether or not you formed an LLC or a corporation, we'll lend to that entity because that entity will own the building, but I'll require both of you to sign personal guarantees because that is the financial strength behind that deal. Remember, I have to get paid back, so if that building doesn't work out, I have to go over that to you and get my deficit out of you guys personally. So by personally guaranteeing it, that allows me to do that.
So tell me about this personal guarantee. Does that mean that if we fail and you have to come take that property back, that you're going to come take some of our personal assets to take care of that loan?
Possibly. Think about it as a pecking order. If it doesn't work out, we will try to sell that building and get our money out, okay? If there's a deficit there, for whatever reason, it's not worth what I had into it, I will then come after you for your personal assets, okay? And that's where things get not friendly. I don't want to do it, and you don't want to have it done to you, but remember, I have to get my members' money back. And this is what we have to do under a worst case scenario.
So what I'm hearing is that if there's more personal guarantors, it's more likely that the loan will be approved.
That gives me deeper pockets under a worst case scenario, yes. Oftentimes when a new developer comes in, and I call it bootstrapping, they don't have tons and tons of money, but there's somebody willing to come to the table as a guarantor that I know that if the deal doesn't work out and I'm not able to get what I need out of you, that person there or the other person there will be able to make up the deficit. So that reduces my risk and makes me happier.
So what kind of paperwork are you going to need from us? What all do you need for a borrower for you to get started to look at our credit?
The way that we begin is to start with a personal financial statement. And that's simply a list of all your assets and all your liabilities, credit card, car payment, that type of thing. On the asset side, it would be money you have in the bank. It would be a home if you own it, the value of your automobile, that kind of thing. And to the extent that your assets are greater than what you want those assets, that's your net worth. Okay, so I need that. Then I want to see how consistent your income is. Okay, because I know you want this building to fund itself, but if it doesn't, I have to feel comfortable that you have enough excess income personally to make up the difference. So I'll want to see 2 or 3 years of personal tax returns for you. And because the LLC is new, you don't have any information on that, but if this was not your first deal and you've used this LLC before, I'd ask for the same thing for that entity as well, but I'd skip over that. And what I've asked for you, I'd ask for all the guarantors. Now that's just from the financial side. In terms of the project, you know, a modified version of what Monty showed up here would be fine. I've never seen anything that complex. You know, usually people buy 1 or 2 homes, you know, or one at a time and all that. That's pretty simple. Here's the home, here's what I'm buying it for, here's how much I think it's going to cost to get it livable, and here's what I think the rent's going to be, validate that, and then kind of do a pro forma thing like that. Some pictures of the property. Because it's South Bend, I know a lot of the neighborhoods, and I can validate whether or not I think the values are correct, blah, blah, blah. And then that begins the conversation.
So our project is 6 units. It's 4 retail units and 2 residential units. So where does that, is that a commercial loan?
Yes, absolutely.
It's not a residential
No,
mortgage.
no, no, no,
That's a commercial loan.
A commercial loan. As you said up on the screen, residential loan would be a 1 residence or up to 4 or 4-plex type thing. But if you have commercial and retail, I mean, commercial and residential mixed in, it'd be a commercial loan where we would provide a small construction loan. And then when that's done, it'll turn into a mini perm where it'd be 5 or 7 years based upon, and we'll go out to 30-year amortization to keep the payments really, really low. And that would give you 5 years or 7 years for you to get things stabilized and all, so that when it does come up for renewal, all the risk has been stabilized, and you've had your sea legs, so you've done it, you know, you're more knowledgeable on it. And then we can look at renewing it from there. I would even consider maybe dropping some of the guarantors if everything is real, real sweet at that point forward, because to me, the risk is less.
Tell us about this term, so you're saying that you're gonna give us a loan, amortize it out, the payments like it's 25 or 30 years or 20 years, but the loan's due in 5 years.
Right.
What happens if we can't, if we couldn't pay the, so you're telling me that the loan has to be paid off at the end of 5 years unless you renew it, or unless, you know, tell me what happens if we can't refinance it.
Right. This is what's really
Even
important.
if whenever our payments are current, what would happen to us if maybe your bank, some banks that I've heard in the past would change their mind. They started off lending and then they changed their mind. They don't want any more than just loans.
That's a risk, okay, because up front, I can tell you, well, we'll work with you and da-da-da-da-da, but the legal contract technically says at the end of 5 years, you owe me that balloon amount, okay?
So all the balloon amounts, that all unpaid?
All the unpaid, you have to give me a check, okay? So let's say the world changes, you know, I get hit by a beer wagon and somebody else comes in and nobody wants to do this stuff. They'll just say, I'm sorry, we don't like these kind of loans. Your loan is due for the contract, pay me, okay? So you have to be careful. That's a huge risk. That's a worst case scenario. So what you want to do is, if you can go 7 years, if you can talk me into going 7 years versus 5, or even 10 years, the longer the better, right? Because that gives you flexibility. Because any time in there, you could take it to another place. You can refinance it elsewhere. We do not charge prepayment penalties.
So if we pay it off early, you don't charge us any penalties?
No. No. This is about you. We're trying to create win-win scenarios, right? You win, the credit union wins, the community wins. What we're really talking about, which is where we have to talk, is what happens if it doesn't work out, right?
What happens if for 5 years we can't get it
Right.
financed?
Okay, worst case scenario.
So we've had a COVID year. We had a COVID year. We didn't make any money last year. In fact, we lost money in our 2 businesses. In fact, my credit's not good. Hers is good, but I have a little bit of money. That's why we're partners. So I have bad credit and she has good credit. And then, so we didn't make any money last year, and then we're coming up for renewal.
Okay, now, under that scenario, you have had your business running for 5 years. So I will put more emphasis on what that property or that project is generating on its own and less on what you're doing. Whereas if you come to me up front and that's the case, that might be a problem because I have to I can't count on something that doesn't exist. So I'm going to look higher, a greater percentage on what you're doing and less on the project. But at the end of the day, if the world changes, at the end of those 5 years, you could have been the most perfect customer in the world. And the bank would say to you, we're not going to accept it. Oh, wait. And then you're going to have to either pay me off or shop it elsewhere. That's why one of the strategies about a year before the loan is due, if we haven't been talking before that, start dropping in and talking and start feeling me out to see what the credit union's appetite is to renew this loan so you don't have any surprises. Right? What you want to do, if I tell you I can't renew your loan in December, this gives you, now we're in February, that gives you 7 or 8 months to shop around the other places. You won't be in a panic. Bonnie said it best, never shop for a loan when your back is up against the wall. Bankers hate that because that's risk. So what you do is say, well, I don't like the way the bank's treating me. You go to someplace else. And I'm looking to refinance this. I've got good numbers. Would you be interested? Yeah, if I could steal this, a loan from a bank or something, you do it that way. You just don't want to have surprises. So just proactively manage.
What about this? What if we've got these 6 units, we've got 2 of the retail spaces already leased, and 2 of the residential spaces are leased to our family members. So we've got 4 of the 6 spaces leased. Does that help us?
It's better than not having it leased. I would want to look at the lease agreements. Family members, it's harder because I have to have a high confidence that you're going to be able to pay the rent. In order for you to pay my payment, and in order for you to pay my payment, you're going to have to collect past due rents from your tenants. That means you may have to go to your mom or your dad or your brother or your cousin and try to get money out of them, and that's going to be hard for you. So I view that as a little softer. It's not a formula. It's just gut feeling. Those of you in there, you know what I'm talking about. If I owed you money and I'm a stranger, you're more comfortable coming after me and getting the money. Whereas if I'm your cousin or your brother and you know the problems I've had, you're going to kind of go, eh. But then you have to make the payment to the bank of credit. So that ripples through the process.
In my financial statements, if you see that I'm working with an accountant that has been known and a lawyer, does that help my situation?
Yes, it gives me a higher confidence that the numbers you're giving me are correct, okay? Because you give me a crayon and a cocktail napkin, and I can write down any numbers I want, right? I want to be confident that if you say it's going to cost $60,000 to renovate, show me. And if that's just the hard cost, who's going to do the actual work? And are they licensed or are they experienced? If you're not a carpenter by trade, it's very expensive to get somebody to put in toilets, tubs, and all that kind of thing.
We've decided to do it ourselves. We're going to do it ourselves because we've been watching YouTube, and we think we can do it. We think if that Joanne and that guy down in Waco, they rebuild those houses, they can do it. We feel like we can do it.
Check, please. Time to go. Game over. Done. Not going to happen. Not going to happen. Right? Because think about it. So you're asking money from me, and then you're not contractors and plumbers and framers and roofers, but you're going to do it yourself. Not with my money, you're not.
So what about this? What if we've never done this before, but we're hiring John's Plumbing, who's been around for 20 years. We're hiring, Jason's Electric and Bob the Carpenter. Bob the Carpenter over here, he's going to help us manage this. Oh, by the way, Greg Keel, the architect, he's gonna watch over us too while we do our first one.
Now we're back in business again.
Okay.
Now it's gonna cost more, right? But because the risk for me is that you're gonna put a roof on the building and the roof is terrible. Now we're gonna have to put another roof on the building. Or tear out the plumbing you just put in, put a new plumbing. Or tear out the electrical because you didn't know what you were doing. You don't have that in your budget. Who's gonna pay for that? I don't want any part of that action.
What if we do it in sections? What if we want to do, let's say, the apartments first and then the office space first, or vice versa?
You know what? It all comes down to cash flow. Let's look at it. We'll call that phases. That actually might be a better way to go, rather than you and I risk a lot of money up front. We'll say, we'll do this building first, it's natural. Get that done, leased up, then we move to the second one, and then the third one. So that for me, my risk is not the whole thing, it's just the little piece. And as we move on, my risk becomes less because you've proven you've done it once before, twice before, 3 times before, as you do different projects. See, to me, that shows me that you're recognizing there's risk associated with that, okay? And things can go wrong. So let's walk before we run. And I'll go with it.
So if you're saying if we recognize our weaknesses and we fill those gaps with professionals, then you're gonna look at us.
Well, I'll look at it and recognize. See, nobody knows everything. The problem in this world is that we don't recognize our own weaknesses. So if you say, I'm not good at construction, okay, but I want to do this, but I have this guy, this guy, this guy, and in South Bend, I probably know him. He's great, she's fantastic, great, okay, fine, let's go. Then I'll walk with you. It's when people think they know more than they do, that tells me not only is my risk higher, but it almost becomes unfinanceable because I'm dealing with a borrower who doesn't have a good grasp of reality. Because you hope for the best, you prepare for the worst. And for 2%, 2.5%, I live in the worst case scenarios. I want you to have tons of money, I want you to be successful, but I'm not sharing that with you.
So tell me this, what all kinds of things, let's say that you approved our loan, then what would be the next step? What all kinds of things? We've heard that you gotta have appraisals and other things. What other costs are gonna be related with the bank? Once you said, okay, your credit looks good, our pro forma looks good, you believe us. So what other things are we gonna have to do? What kind of costs? And what kind of terms? Generally, I know you can't really tell us, but generally speaking, you're gonna have to put 10% down, 20% down. What other costs? What other things? What are all the part? Just generally speaking.
And this is where you have to be careful because this is a kind of business where you really can get nickeled and dimed to death, right? So 20% of the amount goes to finance the project. Okay, it becomes the equity piece.
That's what we gotta have 20% down.
20% down, yeah. Now, in addition to that, there's what they call third-party costs, meaning you're going to have to appraise the property as is, and then maybe have that appraiser give me an idea of what he or she thinks that building's going to be worth after you do the improvements. Because if it's it's a $100,000 building now, and you're going to put in 60,000, making these numbers up. If it appraises for 150, it's not good. But if you put in 100 plus 60 and it's worth 200 or 250, now there's a cushion that's good. So we'll do that. So we need the appraisal. You'll also have to get a title policy. So you go to a title company. You may have to do an environmental, which is relatively simple around here in terms of where your neighborhood is, like the groundwater problems and all that. And then they'll be looking at your contracts. How do you know it's only going to cost you $60,000? Show me the bids from your framer, your electrical guy, your plumbing guy, the major people, and show me that they've actually given you a quote on what this is going to cost. And all together, some of that is free, but sometimes it can cost you for a kind of project that we're talking about here. It could cost another $5,000 or $6,000 on top of the 20.
And what kind of terms, what kind of interest rate? Is there any other upfront fees, loan fees, cost, and interest rate?
That is based upon the lender. we at the credit union for our members do not charge fees on the upside. Some people do, okay? Interest rate would be somewhere for this kind of deal in the 4 to 5% range, maybe 6% if your credit package is weak. It's so you may say, well, boy, you know, a 30-year mortgage is 3%. Why are you charging 5.5 or 6? There's more risk. There's more risk because we're building it. We're bringing in outside tenants. And there's all sorts of things that can go, all sorts of things that go wrong. So I've got to have a little bit of cushion in there.
What if the building is paid off? Does that help with any?
It really doesn't matter because when you buy it, you're going to have to pay off the existing debt on the house. So whether or not you're buying a house where the seller has it free and clear or the seller has a mortgage on it, that's irrelevant because when we finance the acquisition of it, that all gets paid off anyway.
But what if we own the property free and clear?
Oh, okay, now I'm with you. Well, if you've got a building that you already own free and clear, that's wonderful because that gives me more equity, more cushion. So if you want a building for $100,000 that's free and clear, and you only need to borrow $60,000 or whatever it is for the 20%, that's a $60,000 loan on a house that you're buying for 100 is going to be worth 200. So
we get to count the
Absolutely.
property that we already have as
Absolutely.
part of our down payment.
Yes,
Count.
yes, that equity doesn't have to be cash. It could be in the value of the property. It's a very good point.
Okay, well, thank you, Mr. Gryp, for talking to us today, and we'll be back in touch with you very soon.
Very good.
So thank these two guys.
One of the things I always ask, I didn't ask it here, is I say, why are you going to be a better landlord than absentee landlord? You don't want to say slumlord, but you know these guys. Well, I care more. What does that mean? You know, how are you going to make that place different? What's the outside going to be looking like? What extra are you going to do for street appeal?
And that's the farmer. The farmer cares about the community. The farmer actually has a different attitude than the guy flipping, the gal flipping. We've got a few more minutes, Marty, and we've got time for questions, and I'll stay around for whatever we want, but what, is that what you want?
Well, sure, I was just gonna say, we haven't really given the audience a chance to talk, introduce ourselves, to be honest yet. Which I don't think we're gonna do, but I do think if people had questions, Monty is here and Tom is here, and if you two are both willing to answer questions.
Oh, of course.
And I mean, we talked a lot about property here. I think everybody in the room is looking to buy property right now, but everyone's looking to get a business up and running, and sometimes a property up and running. So take advantage of these guys here right now and ask some questions if you have any questions about where you are in the process or you know, what you might want to talk to a boss of a credit union about. Well, you've got them here in a very low pressure environment.
Marty, I can start with one from the chat, actually.
Wonderful.
Do lenders generally require pre-leasing or letters of intent? If so, to what portion of the estimated net operating income?
Say that first part again.
Do lenders generally require pre-leasing or letters of intent?
For smaller deals, no. For like what we were talking about here, where there's a small little retail space and a couple of units, no. Now, if you're doing a big commercial building and there's lots of tenants and big dollar amounts, absolutely. But for what we're talking about here in South Bend, I'd say no.
And it comes down to, and correct me if I'm wrong, Tom, but it comes down to the cash flow of the borrowers too. Can we handle the deal if there's no tenants, no letters of intent, no leases? Can we handle it worst case if it didn't lease up? Can we pay those payments? And sometimes they'll take a little bit of a risk if they think that you've got a really viable project. If you've got something that's going to be $5,000 a month for a restaurant, you know, that may not look so good. But if you're trying to lease $500 spaces, probably look at that a little bit different.
Absolutely.
I think the second part of that question is, if you do want the letter of intent, like how much of the estimated net operating income do you want, like the letters to show for?
I wish I could give you a direct answer. It's contingent upon the size of the deal
Okay.
and the financial, normally when you talk about big buildings in big cities, they talk about pre-lease, pre-lease. Something has to be 50 to 70% normally in bigger markets, but none of that's applicable here.
Thank you.
What I'm looking for is a space where I can move into. Like, I want to start a venue for events, parties, birthday parties, and stuff like that. So when I'm looking to do my pro forma, what should I kind of include in that?
So you're buying a building just to do events, Ken?
Yes.
Okay, so that's gonna be like a business plan more than a pro forma. Because
Okay.
you're not really leasing the building out to other occupants. You're actually operating the building yourself.
Mhm.
And I would say today, Tom, you chime in if you want. The event business today is not a good business to get along because of COVID.
Right.
Because the event businesses that I know of are out of business. I mean, they've gone out of business now, but what you would have to do in this case is to prove your experience and that you can sell enough events, in a business plan, which is a pro forma. It's like an estimate. A pro forma is an estimate of what income you think you're gonna get, minus the expenses equals your net income. And so you're gonna have to prove that, up that you can get there with your experience. Maybe you've been working at another hotel or you've got experience doing it. You're gonna have to sell that to somebody that you can get that business in there. Now you'd be eligible for something like that for an SBA loan would be you probably have less down payment through the SBA. If you're buying a building, or you gotta buy the building too, you gotta buy the building and put your business in there.
Mhm.
Yeah, see, you're an owner occupant.
Okay.
So you're perfect candidate for the Small Business Administration loan, SBA loan. And quite often they can do 10% down rather than 20% down. So what they do is guarantee, like generally speaking, 40% of the loan, the bank is on the hook for 50%. So the bank will take a little more risk because they've got that backup.
Okay.
Right, Tom?
Right. When we talk about SBA loans, I'm a bit of a contrarian when it comes to SBA loans. They are very good. They serve a great purpose. I have seen, unfortunately, banks force people into an SBA loan when it doesn't necessarily require an SBA loan. SBA loan is good in that it gives you less down payment, but there are a lot of rules and it's very regulated. Banks make a lot of money on SBA loans and it's easy for banks, okay? So it's not always good for you. So if you go to a bank and they say, hey, this is a great SBA, pursue it. But go talk to a smaller bank or a credit union and see if they would do it without an SBA and then compare.
So before you need the loan, again, go talk to some people. And if you can talk to the higher up at the bank, it's not often we get to talk to the chairman, the president of the bank. If you can talk to somebody high up, I would try to do that.
Okay.
And so remember, whatever you're trying to sell, whatever you're trying to get, whatever you explain to him, he's got to take to his board of directors, his loan committee. And so have you ever done those secrets where you tell a secret around a room and by the time it gets to the end, it's like, so if you don't prepare him well with a simple plan, then he's going to have a hard time selling it to his board because his board's they're looking at him. I can guarantee you he's making his presentation. They're going, well, what about this? Well, what about that? Well, she can't make it after COVID. They're just drilling him. He's making the presentation. He's getting drilled, because they're going to vote on whether they make your loan or not. So he doesn't make the decision by himself. I guess some cases you do, but generally speaking, it's the loan committee. So. Other questions?
We got a question from the chat, I believe. Consuela, if you want to mute yourself, you can ask the question.
Hello, everyone. I must have raised my hand in error. I'm so sorry. I didn't have a question, but great information, Monte and Tom. Very good job. Good, guys.
This lady right here, Consuelo Hopkins, is, if you consider getting into this business, this is the lady right here you need to talk to. And this guy right here too, Mike King. Both of these two right here, this is probably two of the top people you can talk to about incremental development. South. She knows, she's doing it. She was doing it before us. Now she's put it into higher gear now. So both of these two.
You guys have been really helpful. And Tom too. Tom, I'm excited about it. Everyone's in the room. Now I wish I had came out, but I was putting boardroom tables together tonight and boardroom chairs. So that came in. So I had to get that done before tomorrow. So, but thank you.
I guess, how do you evaluate kind of like the commercial loan to know whether it's good or not for you? I don't know how else to explain it other than some of these loans seem really complicated in the way they're constructed. And I talked to like a banker this week and it was like, oh, I can do 15-year amortization, first 5 years is fixed rate, 20% down. I'm like, is that good? I don't know. Like, how do someone who's just knows, say, like a residential mortgage, which are very, very simple compared to some of these, how do I evaluate these things and learn about them?
Yeah. You know, it's like anything. You talk to one person and they give you this stuff, right? Your head's spinning. The only way you're going to validate is talk to somebody else, right? You have to get input from a lot of different people, and the truth is in there. What I would do is keep talking to folks, and they're going to tell you how they think things should be, and find somebody who can talk to you in a way that you connect with, that makes sense, and can make it as simple as possible. Like I said, this is not complicated if you think about it in those terms. You can make anything really complicated, but it really isn't that crazy.
It's one of the reasons to start small again, is to practice this. A doctor practices medicine. A lawyer practices law. Why do they practice? Because they're never good enough. In the same way in this, we want to practice this, and you want to practice, and you can ask loan brokers, you can ask bankers, you can ask other real estate people, you can ask guys like Marty and Willow and Alkina who are here. Ask, Consuelo, start asking. And when you interview, go around. I mean, I promise you guys out there, if you just go around and interview 3 banks here in town,
you'll know.
You would know so much, and you can read on their website what they do, and you can ask them other questions I didn't ask earlier. It's like, some banks only loan on consumer loans and cars and things and houses. Some of them won't do commercial loans. Some banks won't do it. And a commercial loan, if you're buying a house, a duplex, and you're fixing it up and you're going to rent it, that's a commercial loan. That's not a mortgage. It's not something you're going to live in. So that's a commercial. So that's how you just get it. And when you're in the farm, you know who the bankers are. See, these guys already know each other that are here because they're farmers. So they're working in the community. They know who the bankers are. They're getting used to them. They're sharing information. One of the reasons of incremental development is that we started this organization is to share this information, because what we found in the real estate world, especially in the commercial real estate world, it was very private, or only the rich people across town in my city, they shared the secret handshake. So we didn't know how to do this. I didn't grow up. My mother was a telephone operator. My dad was a carpenter. So I'd never been taught how to do this. So you have to get out there and do it. And by doing these transactions, you're going to get better every time. You can ask Consuelo, who did hers. If you're just new here, you want to talk to somebody who's really done this wrong, quickly go talk to her. And that's how you're going to learn. And you're just going to learn it like anything else. You're going to learn what the rates are, what house prices are, what rental rates on commercial is, those kind of things. You're going to learn it. You can watch the prime rate. You can read that. I wouldn't get too buried in that stuff though, reading all of that in this kind of business. I would talk to bankers and other people. Yes, ma'am.
I'm doing something much smaller. I saw it mentioned on your presentation though, food truck. The food truck would already be owned, but I would need money for the actual retrofitting of the Yeah, of the auto, right. And equipment.
Yeah.
So that would be a small, obviously, I don't
Yeah,
think
that's
it
a
would be a
small business
commercial,
also.
it would be a small, okay, as opposed to.
Yeah, it wouldn't be this because it's not real estate.
No, yeah, I knew it wouldn't be that. I was just wondering if it, okay. It would
Absolutely.
be like that.
But you know what you could do to make that, sweeten that deal, to make that deal better?
Mhm.
If you could find a commercial piece of property somewhere
Mhm.
that you could buy cheap, you could buy really cheap,
Mhm.
and you could park that food truck on that commercial property.
I actually already have somewhere I can park it.
Do you own the land?
I don't, but I.
So I'm talking about if you own the land.
So it wouldn't make a difference if I already had a location?
Well, no, I'm saying it'd make it easier to bank possibly if you went and bought some land, let's say you could buy a lot for $5,000.
Okay.
And you could put that truck on that lot, and then you took that lot with your food truck, you might have more collateral, land you would have. So you would have a real estate deal in that case, mixed with some business property, not real estate, but may make it easier.
It's always kind of incremental. You know, you start with what you need, and if that's not enough, a good banker will say, what else can we do? What else can we do? Not yes or no. It's always great. So is there a lot or is there something, you know? And then you try to get it so that it doesn't break your back and it makes the banker comfortable.
Yeah.
And then you got your deal.
These bankers may be, you may go and say, it's got to get all that paperwork and stuff, but let me tell you, the best partner to have in the real estate business, the best partner, better than some partner that gives you money that wants part of your deal, or one of those hard money lenders, those are the guys that loan 14% interest. The best partner you can have is a bank or credit union. When I say bank, I mean credit unions too. They're going to be the best partner. They're going to have the lowest interest. They're going to have the most legitimate, transparent deal than these other kind of lenders, or a partner. So if a partner comes along, they may want 50% of your deal. And that's 50%, by the way, forever. He goes away after you pay him off.
The other thing to think about too, and this is just a little bit self-serving, but if you're a small developer, a small business person, number one, you want to be local, okay? Try not to go to a national bank, right? Go to a local financial institution, all right? For a lot of reasons, but remember, our lowest common denominator is we're all human beings, okay? And if you go to a local entity, credit union or bank, those people care about this town. It's not just a job, okay? They're gonna relate to you, they'll connect with you. Because they're smaller, they'll probably have incrementally more influence in making a decision. So it's kind of counterintuitive, but try to stay local, and within those, try to find the person that you connect with the best, and you just have to interview, talk to people. Because at the end of the day, it's one person having trust in another person, both ways, right? And the only way you're gonna know that is to talk to different people and see which one do you feel the connection. And then you pursue that.
I have a question, Tom, about, or Monty, about sort of like sequencing your financial decisions. So let's just say like, I'm a woman entrepreneur, I have a business that I want to launch, but I also rent. So I don't own my own home. I don't have that kind of equity. But I want to get into, I want to own the building that I want to open this business in. What would you suggest in like the sequence of my steps to be able to start to acquire property? Like, do I need to own a home first before I take that next step?
Think about it. It's kind of like what we were talking about with the food truck, okay? Start with the basics, okay? You want to start a business, right? What does that look like, the dollars and cents? Is there enough there for it to stand on its own? You may not own real estate, but you may have money in the bank, or you may have a family or a friend who'll come in and help you guarantee. So then you don't have to expand it out. If that's not the case, you say, okay, well, is there some real estate there? So don't jump all the way out to here. You may have a problem solved here. So you start small and say, is this going to do it? Yes or no? No. Okay, a little bit more. How big would it be? You know, and before you have 2 projects, you gotta have 1, right? And the first one's always gonna be the hardest, because that's the one you're gonna make your mistakes on, right? If you don't think you're not gonna screw up your first deal, you're kidding yourself, right? Because you are. You'll probably screw up the second. If you're like me, you'll screw up the second and the third one too. But you just gotta get in there and play. You've got to play in traffic. That's how you're gonna know. So don't overthink it. Start with what you want to accomplish, and then kind of see where you need to go. What do you think?
Exactly. You know, it's easier to own a home. You know, it's easier to finance mortgage on a home. You know, because you can do what, 3% down, 5% down, or whatever you can. It's easier to get that. So if you don't own a home, I would say, you know, go buy one. Go buy a home. You know, buy your own. You know, get your credit cleaned up. Get your down payment together. Go buy a home with a mortgage. So that's the way I started. I mean, I started by buying homes with a mortgage, fixing them up, and then selling them, or leasing them. That's how I started. Because that's the only way I could get a loan. Because I didn't have 20% down. I didn't have that. I couldn't get that much money. So that's how I started. And I just did it over and over and over. I just kept doing it, kept doing it.
Well, I think that's the why I asked about the sequencing, because this, like a lot of women that I work with, and I was in this situation myself, like after my divorce, and like having my own business, like it's harder to acquire property when you don't have consistent income. And sometimes when you're a business owner, you know, stuff fluctuates. So that's why I was just kind of curious for, you know, people that are in that situation, like they're wanting to get ahead, they want to build wealth over time, but like what's sort of advisable as the steps in here?
Again, I go back and think about what the bank cares about. They don't want to lose money. So if your income is up and down, it's inconsistent, right? The way you offset that is to borrow less on the home. So if the home's worth $100,000, don't ask for a $97,000 loan. Maybe you put 20% down, maybe you put 30% down. So you offset the income instability with having more equity, so that my loan, the value is less. So that if you do blow up, I know I can foreclose on that property and sell it, and I'm cool. That's why I say there's always, you know, there's barriers. It's just how do you get around the barriers? Because there's tons of barriers.
And so sometimes you think about it, you want to, you know, you got to put more money down, so I've got to go, so you can go borrow 5,000 from you, 5,000 from you. You know, you can break it down, break it into smaller pieces. It might be harder to get more, and I've done that in the past, borrowed money from several different people. This gentleman had something.
Just a quick question. Would, for example, the credit union or bank, would you, let's say, I was looking to buy a commercial space, the owner wants to sell it for $100K, but it appraises at, let's say, 65. Is the bank or credit union making that move to still give you a loan above that appraisal?
Usually it's the lower of cost or appraisal.
That's a tough situation. Unfortunately, here right now, it's changing, it's going up.
Yeah.
But in the past here, that's been a very common problem. But we're seeing comps here go up right now, but so you're gonna have to back up and figure out how you're gonna do that. It still might be a good deal. You may just have to raise cash.
Yeah.
Let's say that it's worth 65 and you're paying 100. You're gonna have to raise that 35 plus the down payment. You'll have to, but it may be a cheap deal. You're buying it may be worth it.
Yeah.
So sometimes if the guy's trying to sell you something above value, they'll take a carryback note. They'll finance it. I don't want to get too complicated there, but they'll allow me to be in first place for the 55, and then for that excess, that 35, they can have a second mortgage on the property. That's just.
Yeah, actually, the city of South Bend has got, you know, some funding for that. Not very much. I don't want you. I mean, they've got some funding to do that, where a bank can do the 50%, and then they do a percentage, or 60%, and they do a percentage to help that.
We're actually doing one right now, and it's really a good deal. It really is.
And then to even make a real situation a little more complex, let's say, as you're asking for these loans, if I was putting a pro forma together for 2 properties that I'd like to flip, is it more appealing if that pro forma is based off of keeping it as rent, or the pro forma is based off of flipping the property and then just selling it out? Is any one more appealing than the other?
You know, if it's a flip, I would be worried about how long can you carry it if you can't sell it, okay? And if you want to keep it as a rental, it's just a matter of, you know, what kind of rent can you charge and what kind of vacancy. There's no, you know, one's better than the other. It's just variables.
So they're gonna look at the worst case situation. But one of the things you can't do, and this happens to me a lot where I work, because they don't appraise. So I might buy a property, fix it up, and it won't sell. I can just lease it, and it doesn't even, just barely breaks even right now. But soon, because I'm a farmer, then I did another one. And when I did the second one and got it leased up, the first one became worth more. And then when I did the third one, then the first 2 became worth more. Because I was fixing, and that's what Mike Keene has done in his neighborhood. He's made his own things go up, you know, over time. And Consuelo's done the same thing in her neighborhood. They both done that. So you're lucky right now that you live in South Bend, because I can tell you that out of all the cities that I work in all over the country, so South Bend right now, we wouldn't be here. This wouldn't be happening tonight if it wasn't for the city of South Bend. And Marty, Alpina, and others that are working, many others have worked. South Bend recognizes the value of small entrepreneurs and diverse ownership of property. They recognize that that's a big deal. That's a big value to a city, because the healthier the middle class is, the healthier this city is going to be. It's not just the rich owning real estate. South Bend's made a conscious commitment to make that happen. So if there's any city to be in right now, this is the one to be in.
Can I say something? We talked about it a couple times, but I think it's important to kind of emphasize it here, that how many of you guys know what your credit score is? Okay, good. If you don't, you should, okay? Because that's what bankers look at to determine how well you've handled credit in the past, okay? So, what's a good credit score? What is it? There's no black and white. I tell you, we like to see it above 650 or 680, okay? Doesn't have to be there, but if you're below 650, you're gonna have a problem. You know, banks are gonna go, okay? So, if you know what your credit score is and it's above that, that's good. If you look at your credit score and it's not that, you have to address it head on, because that's a game stopper. Because you're coming to a bank saying, please trust in me and make me a loan. And I'm gonna go, but what? So you stuck it to this guy, but you're not gonna stick it to me? You know, I don't think so. Okay, so in those, and that happens. I call that stuff happens, all right? Just address it up front. Get with somebody and repair your credit. It's easy to repair your credit. All you have to do is focus on it, okay? There's some simple steps that you can do to increase your credit score 10 points, 20 points, 50 points, okay? But make sure that's tight as a drum when you come into a financial institution. Because if we're sitting there, okay, and let's say, Marcella, your credit score is horrible. Let's say it's 580. Even if Monte's guaranteeing it, I don't know, because you're the lead on it in this example, right? You know, and if you're my primary person and you're just the backstop and your credit is really, really bad, you know, you don't want to get into business. Think about it. You don't want to get into relationships. You don't want to get into businesses with somebody who's not trustworthy. Remember, the lowest common denominator is me working with you, okay? And if the tables are turned, it's the same thing you guys are doing. So look at your credit score, hit it straight on so that when you come, because oftentimes in a meeting like this, I'll say, what's your credit score?
We got a couple more here.
Yeah.
I also want to be just cognizant of the fact that we are beyond 8:30 at this point, so I know folks have families they need to get back to. Feel free to get get up. If you want to stay, you are very welcome to stay. We can keep talking as long as you guys are willing to stay here and
Yeah,
ask
stay.
questions. But
got-
it is 8:30.
Got
So go ahead.
We have
read
two
it off.
from the, one's in the chat, and Mike, you had your hand up. The one in the chat is, how much should I include in my budget for replacement of depreciating assets like carpet, appliances, and other? Did you understand what I said?
Yeah, the depreciating assets, that's what we call a reserve. That'd be like a reserve account. And what I would do, like roofs, carpet, air conditioning, all of that stuff, I mean, I would probably try to be putting at least 10%, about 10% a month in, put it back. I mean, if it's an old property, it depends on what it is again, but I'm just giving you kind of a general rule of thumb. I would probably put 10% in reserve. I probably don't do that in all of my properties, probably put less. I'm always trying to put something back.
And Mike, your hand is up. You are unmuted.
Yeah, I just wanted to say a comment to the woman who was speaking earlier about, should she buy, a house or buy a business? One of the things, particularly after COVID, but it's a product that we've been starting to work with and we've seen before, is the ability to go to certain areas where you can do work, live, where you can actually live in the place that you work. So it's not, do I get a home or do I get a business, but can I find a small property where I can live in it and do my business? Or maybe I get my home and I can put an office in my house, so that you're doing that together. And then once you build enough equity for that, then you can move on beyond that.
I've done that. I've lived in my office. When I first started, I have an office. I lived in my office, but I was able to buy it, build it. Anybody else? Okay. So we hope that you will things come into your neighborhood. You realize that nobody's coming. Nobody will. And if you want to pass on generational wealth to your family, and I always say this: work like you're going to live forever, live like you're going to. So if you work like you're going to live together, if you're 60 years old today, you can pretend you're 20. You keep doing it.
Thank you for everybody coming. We didn't have a sign-up sheet. We didn't even do introductions, which I feel bad about. We're going to hang around a little bit, so if you want to come up and introduce yourself, I don't know if people have business cards they want to share, that would also be fine. I know some of you we're going to see tomorrow because Monte's in town all day tomorrow, and we're going to do some one-on-one visits to the folks, but stay in touch. I can give you my business card. We can keep talking as you move forward. I'd love to hear how you're doing and if there's any way that we can continue to be of assistance in your journey.
Well done. Well done. Thank you. Alkina, did you want a tour?
Why, yes, ma'am.
I'll take you around.
I've only been on the outside. I think I've seen pictures online, and now I'm like, ooh.
Now, keep in mind, this was all like 1950s, 40s. It was all paneling. I should say 60s, right? So this is the boardroom. Our boardroom table and chairs. I'm just were back ordered, so they're just getting in, and it's tax season, so I'm trying to get them set up.
Yes,
This is
it looks
gorgeous.
so good.
I got blinds that you hit one button and they all come down together.
Ooh, fancy boardroom one.
This is the break area. We're waiting on the countertop, but this is we're gonna have a bar area in here where people can sit and plug in.
Yeah. I like the color selections. It has really modernized the place.
Absolutely. Let's see. So let me just show you. This is one of the smaller ones. My property manager will go in here. So this is one of the spaces. Can you see it?
Mm-hmm.
Okay.
Nice.
And it has.
Manager space.
Yeah. Let me get the light on. Still learning this place, right? There we go.
And as soon as you learn it, you'll be on to the next one.
I know that's the goal, right? That's the goal.
Yeah.
So isn't that gorgeous? That's the restroom.
That is so pretty. I love those. Are those like glass subway tiles? It's pretty.
Yes, yes, they are. Yeah. So all the restrooms, there's 3, 2 upstairs and 1 down, has that. It's another office space. So they're all about that size. You kind of go. Let me show you. Oh. This is one of the bigger ones.
Oh, wow, that's a big.
Yeah, it's a nice space. It has a closet. Too. So that one has a closet as well. And one more restroom upstairs.
Ooh, and that subway tile I like. Yay. You went on mute. I think David might have put you on mute.
Sorry, David.
we could be like projecting while they're still in the meeting there, but
okay, well, we
that's
better
all right. I'm so excited about what you're doing, and I can't wait to see it in person.
Look at
Killing it per use. Ooh, come on, Sputnik light. I want one of those.
Isn't that nice? This is the vestibule. So what I'm working on now, yes, exciting, is the tile that was on the floor.
Mm-hmm.
I think they're recording. Maybe we better stop.
Okay, I'll just call you.
Thank you.
Okay, bye.
Thank you. Bye-bye.
Everybody came forward. Yeah, I was like, could not go.
Now, that's a manufacturing, that's more of like assembly, that type of thing. But I always say that we will have a real assembly and then manufacturing, a small business. An entrepreneur can plug in really, really nice stuff. Oh, that's good.
You were very brave with your relations.
Maybe our very proud.
Like, she would run around in the hallways, out someone, making, yeah.
Uh-oh.
Yeah.